This is Jim Emter, Van Ahn Company, Alexandria, Minnesota, with your closing grain and livestock comments for July 10th, 2018. Corn market down 5 to 6, soybeans down a half to up a half. Wheat across the board, 10 here in Minneapolis, a little bit bigger when you get to Kansas City, Chicago, kind of that 11 to 16 mark. So a weaker day once again. Beans kind of stemmed the rally potential. Wheat led the charge lower, and corn kind of stuck in limbo, but succumbed to the weakness there as we work through the day. Some of the key numbers here: corn market, December closing at 360 3/4. Low was down around that 357 area. We were able to come back through, in that 360 area, as you've heard through this update, is a key support area for this market. So being able to get back above it was important to kind of frame up this bottoming type formation. But now we've got to get through a Thursday crop report where market's expecting some yield increases and some concern over the demand structure of what USDA does as a result of these tariffs. The bean market, after trading as much as 9 higher and 9 lower in the day, settled around steady, held that 860 support there as well. So we kind of continue to look to that as a base recovery point, a base support point that's holding up reasonably well here. We hit 862, I believe it was, here today off the November contract. And then off the wheat markets too, we were able to come down, fill a gap action that was created. So we were able to get above the 200-day. We came back, break below the 200-day, fill a gap. And now what we do for the rest of the week is of importance here. When you look to kind of that wheat structure, some of the bullishness has been tied to the EU structure. So you got to envision some rain in that area helping out crops to some degree, but still not out of the woods yet. So we'll see if that kind of filled action allows this market to extend a little bit and trade back to that 200-day, or whether we break down here. Something we're monitoring very closely. But in real time with these NAFTA negotiations and uncertainty in the over trade, that's some of the big parameters we're really viewing right now. Feeder cattle market up 20 to 40, live cattle steady to down 80, hog market down $2.35 to $3. So unfortunately, let's start in hogs here today. We've talked about the importance of that market trying to maintain. Unfortunately, with the lower feed products, we believe this market's at risk of putting on weight, and we're seeing that sell pressure that we've warned of really coming to fruition. So it seems like that quick exit down into this 48 area looks to be the case for this December hog market. We'll see if we can find support, but a nasty trade today, new lows, and we continue to press, and that seems to be the target market's looking at. For the cattle market, it's kind of a bend but don't break too far. We are in an uptrending channel. We've got feeder cattle that we're able to hold the strength, live cattle that are trying to do their best not to break too far. And I see a cattle market fundamentally that sees some health here into the late summer and fall time frame. And we continue to sound like a broken record, but we want to be confident that in this uptrending market, we can accept pullbacks like this as long as we keep extending into new high territory and bringing that investment money flow. And we believe that's what will happen here as we work into late summer and fall. So, bend but don't break too far cattle. Unfortunately, hog market, we're in a break mode, and we'll see just where this washes out into. This has been Jim Emter, Van Ahn Company, Alexandria, Minnesota. Trading in futures and options involves risk of loss and is not suitable for all producers. Past performance is not indicative of future results. This is a solicitation. Have a great afternoon.